Preparing for a bank guarantee operations interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What is a bank guarantee, and why do businesses use it? A bank guarantee is a bank's written commitment to pay a beneficiary if the applicant failed to meet a specified obligation. I would explain it as a credit substitute. The bank does not pay up front, but lends its credit strength to support a contract. In operations, the focus is on accurate wording, approved limits, collateral, commission setup, SWIFT or paper issuance, and monitoring until expiry, cancellation, or claim. While answering, focus on the guarantee as a contingent obligation, the roles of applicant and beneficiary, commercial purpose, risk transfer, and the operations team's responsibility after issuance. Question 2. Who are the main parties involved in a bank guarantee transaction? The core parties are the applicant, the beneficiary, and the issuing bank. The applicant requests the guarantee, usually to support a contract. The beneficiary receives protection and can claim if conditions are met. The issuing bank undertakes the payment obligation. In cross-border cases, an advising bank may authenticate and deliver the guarantee, and a counter-guarantee bank may support an indirect structure. Operations must identify every party correctly for sanctions, KYC, SWIFT routing, and documentation control. Make sure to cover applicant, beneficiary, issuing bank, advising bank, confirming bank if relevant, and the difference between customer-facing parties and correspondent banks used for delivery. Question 3. Can you walk me through the end-to-end process of issuing a bank guarantee? I would start with the customer application and underlying contract details. Operations checks whether credit approval, limit availability, margin, and required documentation are in place. Then the guarantee text is reviewed against bank policy and regulatory requirements. After maker-checker verification, charges are calculated, accounting entries are posted, and the guarantee is issued either physically or through SWIFT. Finally, the record is diarized for expiry, amendments, commission recovery, and possible claims. In your answer, talk about application receipt, credit approval, collateral or limit check, legal text review, commission setup, issuance mode, SWIFT authentication, maker-checker controls, and record maintenance. Question 4. What are the common types of bank guarantees handled in operations? The common types include performance guarantees, financial guarantees, bid bonds, advance payment guarantees, retention money guarantees, and customs or statutory guarantees. A performance guarantee supports contract execution, while a financial guarantee supports payment obligations. Bid bonds protect tendering processes, and advance payment guarantees secure funds paid up front. From an operations perspective, the type matters because it drives text clauses, expiry rules, commission rate, collateral treatment, regulatory reporting, and the likelihood of claim. Be sure to mention financial and performance guarantees, bid bonds, advance payment guarantees, retention guarantees, customs guarantees, and how operational checks vary by purpose and claim wording. Question 5. What is the difference between a bank guarantee and a letter of credit? A letter of credit is primarily a payment mechanism, while a bank guarantee is mainly a risk mitigation instrument. Under an LC, the bank expects to pay if compliant documents are presented. Under a guarantee, payment happens only if the applicant defaults and the beneficiary makes a valid claim. Operationally, LCs involve detailed document examination, whereas guarantees focus more on wording, liability tracking, expiry management, amendments, and claim validation under rules such as URDG or local law. While answering, compare purpose, trigger event, payment expectation, documentary nature, risk profile, governing rules, and how operations teams process issuance, document checking, and claims differently. Question 6. What documents would you check before issuing a bank guarantee? Before issuance, I would check the customer application, approved credit sanction, limit availability, margin requirement, and underlying contract or purchase order. I'd also verify authorized signatories, board resolution if needed, KYC status, and beneficiary details. The guarantee format must match approved wording or receive legal approval. Depending on jurisdiction, Stamp duty, regulatory declarations, and collateral perfection may also be required. The key is not issuing until authority, exposure, and wording are all controlled. Make sure to cover application form, board resolution or authority, underlying contract, credit approval, sanction terms, collateral documents, KYC status, guarantee format, and regulatory or stamp duty requirements. Question 7. How do banks calculate and recover commission on bank guarantees? Commission is usually calculated on the guarantee amount, tenor, and approved pricing rate. For example, if a guarantee is for $1 million at 1% per annum for 6 months, the basic commission is $5,000 before taxes and minimum charges. Some banks recover it upfront, while others recover quarterly or annually. Operations must ensure correct value dates, tax application, income accounting, and periodic recovery. Missed commission recovery becomes an operational and revenue leakage risk. In your answer, talk about guarantee amount, tenor, commission rate, risk category, upfront versus periodic recovery, minimum charges, GST or tax, accounting entries, and overdue charge monitoring. Question 8. What operational controls are important while issuing a bank guarantee? The most important controls are limit validation, sanction compliance, maker-checker review, and approved guarantee wording. Operations should not rely only on the relationship manager's request. The system record, customer application, and final guarantee text must reconcile on amount, currency, beneficiary, expiry, and claim period. Swift messages require authentication and 4 eyes release. Any deviation, such as open-ended wording or lower margin, should have clear approval. Strong controls prevent unauthorized exposure and fraud. Be sure to mention maker-checker controls, limit validation, sanction terms, legal wording, signature verification, system input accuracy, swift authentication, exception approvals, audit trail, and segregation of duties. Question 9. How would you process an amendment to an existing bank guarantee? First, I would identify the amendment type: amount, expiry, wording, beneficiary, or claim period. If the amendment increases risk, such as higher amount or longer tenor, fresh credit approval and margin may be required. Then I would obtain the customer request, validate beneficiary consent if necessary, recalculate commission, and update the system. The amendment is issued through a formal letter or SWIFT MT 767. The original guarantee record must remain traceable with a complete audit trail. While answering, focus on amendment types such as amount increase, expiry extension, beneficiary change, wording change, approval requirements, commission recalculation, SWIFT amendment, and customer acceptance. Question 10. What is the process when a beneficiary invokes or claims under a bank guarantee? A claim must be received and time-stamped immediately because validity and cutoff dates are critical. I would check whether the claim is within expiry and claim period, signed by the correct beneficiary, and compliant with the guarantee wording. Legal or trade specialists may review ambiguous cases. If the claim is valid, the bank pays the beneficiary and creates a receivable from the applicant, or adjusts collateral. Operations must also update liability, accounting, and recovery records promptly. Make sure to cover receipt timestamping, validity check, claim wording, amount verification, legal review, notification to applicant, payment decision, accounting impact, and recovery from customer. Question 11. What is the difference between expiry date and claim period in a bank guarantee? The expiry date is the date until which the guarantee obligation remains valid. The claim period is an additional window during which the beneficiary may submit a claim for a default that occurred before expiry. For example, a guarantee may expire on 31 March, but allow claims until 30 April. Operations must capture both dates correctly. Closing a guarantee at expiry without considering the claim period can release liability too early and create legal and financial risk. In your answer, talk about operational significance, contract performance date, beneficiary's claim window, liability release, auto closure risk, and why system diary dates must capture both fields accurately. Question 12. How are SWIFT messages used in bank guarantee operations? SWIFT is used to issue, advise, amend, and sometimes communicate on guarantees in cross-border transactions. MT-760 is commonly used for guarantee issuance, while MT-767 is used for amendments. Operations must ensure the SWIFT text matches the approved guarantee wording and system record. Authentication is important because banks rely on SWIFT security to confirm message origin. Free format wording must be carefully controlled, as a small clause difference can change the bank's legal obligation. Be sure to mention MT-760 issuance, MT-767 amendment, authentication, structured fields, beneficiary bank routing, free format risks, and reconciliation between SWIFT copy and core system records. Question 13. What is an indirect bank guarantee or counter guarantee structure? An indirect guarantee is used when the beneficiary wants a local bank to issue the guarantee. The applicant's bank issues a counter guarantee to that local bank, and the local bank issues the final guarantee to the beneficiary. If the beneficiary claims, the local bank pays and then claims under the counter guarantee. Operations must monitor both the outward counter guarantee and related messages, fees, expiry alignment, governing rules, and reimbursement obligations between banks. While answering, focus on cross-border transactions, issuing bank versus local bank, counter guarantee reimbursement obligation, local law requirements, additional fees, and operational monitoring of two linked exposures. Question 14. What compliance checks are required in bank guarantee operations? Compliance checks start with KYC status of the applicant and screening of all parties including beneficiary, advising bank, and any intermediary bank. Sanctions, AML, country risk, and restricted sector checks are critical, especially for cross-border guarantees. Operations should also review the transaction purpose and underlying contract for unusual terms or fraud indicators. If wording requests bypass normal protections or involve sanctioned jurisdictions, the case should be escalated before issuance. Compliance failure can create severe regulatory exposure. Make sure to cover KYC, AML screening, sanction screening, dual-use goods or restricted sectors, country risk, regulatory reporting, fraud indicators, and escalation of unusual wording or transaction purpose. Question 15. How do you close or cancel a bank guarantee in the system? A guarantee should be closed only when the bank's obligation has ended. That may happen through expiry plus claim period, return of the original instrument, or a written release from the beneficiary. Before closure, I would check for pending claims, unpaid commission, amendments, and legal holds. Then the contingent liability is reversed, collateral or margin is released as approved, and the file is archived. Proper cancellation evidence is essential because premature closure can create unexpected exposure. In your answer, talk about original guarantee return or beneficiary release, expiry plus claim period, pending claims, commission adjustment, liability reversal, collateral release, archival, and audit evidence. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.